So Madhav, I'm sure you were not calling for a correction, but you were sounding alarm bells last time when we interacted with you.
Listen, to time these things perfectly is obviously extremely difficult. I mean, in the end, it's about, playing probabilities. And the probability certainly had started to swing completely on the other side, that you have markets that are priced for perfection, both in India and around the world. You have interest rates that have been rising for a year and a half, which nobody seems to have paid any attention to. Markets that are up 30 to 80%, 40, 45 on average in the last 15 months. So you have tremendous price extension, rising interest rate, tremendous enthusiasm, and extremely stretched valuations. So that is usually a recipe, for something very bad to happen in the markets. And the closest analogy to me was what happened in sort of 1987, where you had a similar situation. And at the same time, the economy was very strong. You had Reagan tax cuts, which further bolstered the economy. So it's similar in the sense that it doesn't look like to me an end of cycle phenomena, but a very late stage extended market that would probably have a very, very difficult correction. And it's a part of a global trend, and I think the Indian factors haven't helped either in terms of the budget and the long-term capital gains tax, but it's clearly part of a big global correction triggered by interest rate fears and price extension.
Madhav, how does one figure out that this is a cycle reversal and the pain slightly could be extended? You talked about 1987 and when similar factors were at play, when there was weakness in the dollar index and commodity prices were high and there was a sell-off in the bond market, and we all know that what happened after that. So are you calling for a rather ugly patch of selling in coming weeks, months?
Oh, I think so. I mean, I'm not, I'm watching like everybody else. So yes, I think once this thing starts, I think it sort of feeds on itself, just like, bull markets feed on themselves. And I think so much money has come into retail funds, both in the U.S. and in India, that I think a lot of it will get spooked and some of the money will go out. So you want to see some restoration of fear before this thing is over. And I think 2-3 days and 5-6% correction after the kind of run we've had, I just don't think it's enough. And so, as they say, it's either price or it's time. And in 1987, it was price. Just the S&P fell 22% in one day, for some various technical reasons. So that certainly won't happen. But you need restoration of fear, and that takes a really strong hit to the head, or it takes some time. So yeah, my best guess is that this is the start of a bigger correction. But I still feel encouraged that it may not be the end of cycle, because the economies, if anything, are accelerating worldwide and in India. And usually end of cycle, big time bear markets are followed by, or preceded by recessions, I should say. And I think the preconditions of that are not there. But just like 87, high to low, from August 87 to October, just in the space of 3 or 4 months, the market corrected high to low 35-40%. Simply because prices were high and rates were going up. I just can't imagine something similar would happen. But yeah, I mean, a 15-20% correction is still a correction, and a very painful one. And to me, till further notice, that seems to be, the most likely trend, of which we probably have had a third by the end of today already. So.
Madhav, hi, morning. So for all investors, it's about capital protection. When you wake up in the morning, you see 1,000-point Dow fall, the Sensex, Nifty, mid-caps, what have you, all 50 stocks bleeding. You just want to protect your own capital. You want to safeguard all the returns that you have made in 2016, 2017, up until now. What is it that you do? What should be the right investor approach?
It's hard to generalize. It again depends on how much you have in the market. So to me, it's always a function of how exposed you are. If you're 100% exposed, which is not a particularly smart thing to do, I think you probably have to sell down even now. And let's say you're 50% or 40% invested in this market, you probably step aside and start buying in a week or 2 weeks. So it really depends, what your starting position is. So it's hard to generalize. And I think it should be a wake-up call of the nature of risk and the nature of equity investing. I think it's just been too smooth and too easy for too long, and that leads a false sense of security. And I think the equity markets is the only serious long-term way to build wealth. But you have to understand that what we're seeing this week and last week is the price of admission. And what we've seen over the last year and a half is not real life. So I think in that sense, there's a restoration of risk, a restoration of volatility, which is what goes hand in hand with long-term returns. So it should be in some ways a valuable lesson. And but the flip side of it is that is something to be embraced and not something to be afraid of. And if you're worried about a 10-15% correction and you have a 6-month investment horizon, you should simply not be in the market. End of story. And I think the mistake most retail investors make is they come in when everything looks good, which is usually at late stage of the cycle. I mean, if you see domestic flows into mutual funds, I mean, they've been strong for about 2.5 years, but really strong over the last year. I mean, if you were a true contrarian investor, they should have been strongest 5 or 6 years ago when the rupee was almost hitting 70 and there was a full-blown panic. But that's not the nature of retail investment cycles. So I think the real understanding is that you must embrace, structural fear and panic, especially in a high-growth country like India, and be wary when everything looks awfully good. And, as I said, these things are not easy to time exactly, but all you have to do is get it vaguely, broadly right. As they say, I'd rather be vaguely right than precisely wrong.
Yeah. No, Madhav, when you said structural, I was like, ouch, because what it seems like right now is more in tandem with what's happening with, around with global markets. It seems more like a technical correction just as at this stage. I know the reasons being attributed are, inflation going up in the US and that being a big risk, rates picking up. In fact, as we speak, we've just had a statement from the finance ministry saying, look, don't time this fall with the announcement of the LTCG. That was unfortunate, but it's got nothing to do with it. Do you see this as a structural change of events that the markets are reacting to? Because there's a lot of conjecture out there. Unlike 2016, where the markets fell because of oil and China worries, and unlike September 2013, where there was, the taper tantrums that gripped world markets, there seems to be just a lot of conjecture about, how the macro environment would shape going forward from here. And on that basis, I'd reckon that such a steep technical-led selling is happening, where everybody's just saying, let's press the sell button on valuations. But, if you were to put the picture together, would you say that this is looking like a structural fall or more technical in nature right now?
It's a combination of the two. I mean, I think the technical event is that it's a very, very overbought and very extended market. If you look at all the sentiment surveys and positioning in the U.S., it's extremely overweight equities, almost as 2 standard deviation extreme, which usually has led to a technical unwind, which is part of what we're seeing. But the structural history of markets is severe price extension coupled with high valuations, and they're not necessarily the same thing, amid rising interest rates, and complacency leads to bad stuff, structurally bad stuff. And that's exactly what we have. We have a very extended market, very high valuation, rising interest rates, and nobody thinks it's such a big deal. So it's exactly the triple threat, which is high valuations, rising rates, and complacency. So you've got a triple play going on that will lead to some kind of structural unwind. Offsetting that is rising growth, both GDP and earnings, rising PMIs around the world, accelerating earnings per share revisions, which are going to offset some of this, which is why you are probably in a late stage severe market correction, but not the end of cycle, which is what happened in 87, as I said, that you had a market that was going up from 82, 83, got very extended, corrected sharply in 87, and everybody got completely panicked that this was going to lead to a depression. It corrected and went straight back up to 88, 89, 90. and the cycle ended with the 91, 92, and then there was a recession. So it could be a very similar play out, that it may not be the end of cycle, but there's enough inflation fears that are legitimate, enough valuation fears that are legitimate, and price extension that is unsustainable, and positioning that is too complacent. And you'll get a big time correction. And once that correction happens, then the dust clears, you realize, hey, the world economy is still growing, earnings are still going up, what's the big deal? But that's, either several months from now, most likely, or, 10, 15% from here. That's my best guess. I mean, I'll just see how people react and what the lay of the land looks like in the next week or so. But if I had to guess today, that's what I think is happening.
Right, Madhav, appreciate your time. Thank you for joining us.